Take a look at this. You may have no idea what in the heck you are looking at, but give me 2 minutes and I'll show you why this is the ultimate cheat code to timing the stock market. Now, the chart on bottom is the NASDAQ Composite Index there in white. That's just a general stock market. And on top is a little-known indicator published by the Chicago Fed. And what you'll notice is these two have a near perfect inverse correlation. When a blue line goes down, the stock market goes up. And when a blue line is trending up, the stock market tends to come down. So what is it? How do you find it? How can you use it? And how can it help you better time your stock purchases? Well, let's dive into it. You see, this reading is known as the NFCI, which stands for the National Financial Conditions Index. It is published once a week, every Wednesday morning before the market opens, by the Chicago Federal Reserve. Now, this simple reading, which ranges from +1 to -1, combines everything from home equity yield spreads to repo market volume, loan officer surveys, MBA delinquency rates. There are more than 100 different financial indicators all cooked into this one simple number. And this number, when compared to the week prior, shows if the financial conditions are becoming more or less liquid, whether conditions are tightening or expanding. And in today's stock market, nothing could be more important. You see, up until the 1990s, investing was very active. Most of the money in the stock market was being managed by amateur and professional stock pickers. But over the last 30 years, that has changed dramatically. Today, in 2025, more than half of all investment dollars are passively managed. The majority of IRAs, 401ks, insurance funds, pensions, trusts, and endowments are in index funds that just ride the overall market. And because of that, the overall inflow and outflow of money is what actually drives the market. Now, the NFCI measures risk, credit, and leverage. When these three conditions are loosening, it means more money is coming into the market. Investors are buying riskier assets like stocks, credit is expanding, and more leverage is being used to do so. And when that happens, stocks go up. On the other hand, when financial conditions are tightening, when banks are issuing less credit, when investors are applying less leverage, dollars are coming out of the market, and as a result, stock prices tend to come down. And if you look at these charts, again, you'll notice a near perfect inverse correlation. The other nice thing about the NFCI is it tends to trend very well. And when it is heading downward, you generally have a strong bull market. When it is trending up, and as they're tightening, stocks tend to pull back. So if you see the NFCI, this blue line, going up for 1, 2, 3 weeks in a row, it's usually a pretty good idea to get the heck out of stocks or at least pull back. On the other hand, when this indicator begins to fall, conditions start to loosen, it is usually a great time to be buying stocks as you have the wind at your back, money pouring into the markets, and likely much, much higher prices ahead. And if we go back, even over the last 2, 3, 4 years, I can go further, you'll notice this inverse correlation remains. So let's just start back here during COVID. This is probably the most extreme example and shows it in great detail. Here we have the NFCI kind of trotting along. It's generally trending lower as stocks are trending higher. But look what happened January, February, March. When COVID kicked off, the world was turned upside down. What do you think happened to the financial conditions? They tightened up, the likes of which we've never seen. Banks brought credit drastically down. Leverage went way down. People want way less risk. We didn't even know if the economy was going to function. And because of that, we saw this massive spike in the NFCI. And again, it started rising here, February, March. Look at the corresponding line down there on the NASDAQ chart. So it's up 1, 2, 3 weeks in a row in big fashion from negative 0.63 to negative 0.45. It's a huge spike. And when you see that, you know things are not good. Money's flowing the wrong way. I need to get the heck out of stocks. And if you did so, you sidestepped what was one of the fastest drops in stock market history. The NASDAQ index fell more than 30% in just a month. But just as aggressively and just as rapidly, it came roaring back. Here by April, The NFCI once again began falling, showing loosening conditions. Stocks began to rise, and we had this monstrously strong bull market over the next 6 to 8 months. And in fact, it continued all the way through 2021. So this is going to do a great job of getting you into the good times and out of the bad. The same thing happened here in 2022. Look at the bottom chart. You can see the bear market, which began very end of December, basically the first day of 2022. Stocks sold off all the way down here to June. Little relief and then continued lower. And look, once again, the NFCI put you ahead of that. 1, 2, 3, 4, 5, 6 weeks in a row, it's up. Clearly, things are not going well. That trend only accelerated. Stocks drove lower. The one little uptick we had, the one little relief window here in July and August of 2022 was when the NFCI began dropping. Again, that reversed course, stocks went lower, but once again, it nailed you into the low. As soon as this started falling again, it was time to get back into stocks, and you had a wonderful bull market for the most part. 2023, one little push up, pulls back, it's falling again, market rallies. And this correlation remains all the way up until February of this year, when, of course, the trade war began. Trump imposed massive tariffs on pretty much every country across the globe. Conditions tightened. NFCI ramped up. Stocks came shooting down. And once again, within a week, maybe 2 weeks off the low, NFCI is again falling, get you back into stocks, and you ride what has been a momentous bull market higher. So that is the NFCI, the National Financial Conditions Index. It is, in my opinion, one of the absolute best tools you can use to take a big picture timing model of the overall stock market. Now, if you want to find this for yourself, you got a couple of options. What you're looking at here is TradingView. If your charting package has this, the ticker is just NFCI. You can also go online at the Chicago Fed website. The easiest way is probably just to Google NFCI. In fact, I did that, and this is the top result. It's going to take you straight to the homepage, or this page of the Chicago Federal Reserve Bank. As I said, it updates on a weekly basis at 8:30 Eastern Time every Wednesday. And here it will show you what that reading is for the week. In fact, as of this recording, the NFCI decreased to 0.57 in the week, ending July 25th. Risk, credit, et cetera, indicated. And of course, we can see that here on the chart as it did tick down, showing the market is still in full force. Conditions are still loosening. You still want to be owning stocks. So give this a look. If you've never heard of this, tell your friends. It is by far one of the best kept secrets out there, and it could help you both avoid another nasty bear market and be sure you are fully invested when stocks are on the rise. Now, if you haven't already done so, what are you waiting for? Go ahead and subscribe. There's a little button down there in the corner. Click that, subscribe to this channel. That way this content will show up in your feed on YouTube, and you'll get notified when we put out new information.